And on the standard deduction, they gained $5,500, so that their taxable income went from $39,350 to $38,000. So it went down $1,350, and then their tax went down $1,121.
Yeah.
From
That's a lot of money.
$54.91 to $43.70, and that's driven by the increase in the standard deduction.
Or 20%, that's the question you asked earlier. No.
And then there's no change in their Oregon, because their federal tax went from about $5,500 to $4,400. They're above their cap, so it didn't change their federal tax subtraction. So there's no change in Oregon liability. So now we take that single filer, and this person is earning $180,000. Under the old law, they got the same $4,150 deduction. They itemized deductions at $33,500. So their taxable income was $142,350, and their tax was $32,701. Under the new law, they lost their personal exemption. They went to zero, and their itemized deductions are now $20,000 because of the cap on the personal and the property. And their taxable income went up to $160,000. And so their new tax went actually an increase to $32,890. So here's somebody, because of the specific, I specifically chose dollar amounts to get this result, and showed a tax increase of $189. So that's a 0.6% increase in their taxes. And for similar reasons, there was no change on the Oregon tax for this taxpayer.
And the difference at the federal level is that they're paying at a slightly lower rate on the 160 versus 142,350.
Right.
Okay.
It's a lower rate, but they lost the deductions.
Right, and
And that
right,
didn't yeah.
right.
So it didn't make up for it.
Okay, joint filer.
So here we have, it's kind of two pieces. We have a family of four here, and then I have an example related to the pass-through. So the family of four here has $75,000 of income. Their change, they had $16,000 for personal exemption. That went from $16,600 down to zero. And their itemized deductions under the old law were $19,400. Their taxable income is $39,000, and they got a $2,000 in child credit, because two kids, $1,000 credit. And their tax was $2,898. And under the new law, they lose their personal exemption. They switch to a standard deduction at $24,000. So their taxable income is $51,000. Their child credit went up, it doubled, so they benefited from that. So they got $4,000 in child credits, and their federal tax went down to $1,739, a decrease of $1,159. Now, that flows through to Oregon through the federal tax subtraction. The deductions don't change, but because their federal taxes go from $2,898 to $1,739, their Oregon taxable income increases by $1,159, and their Oregon tax increases by $104. So the last piece here, we have a taxpayer with $400,000 of income. In this first block, it's just regular wage income.
Right.
And the second block, they're eligible for the pass-through entity deduction. So it's $400,000. Now, under the old law, they got a $2,988 personal exemption, $56,000, almost $57,000 in itemized deductions for taxable income of $340,000. They don't have any kids, so their tax is $87,061. Under the new law, their itemized deductions are curtailed. They're still itemizing because they have $25,000. They're just $1,000 above the threshold. And their new tax is $83,379. So they have a 4% reduction in their federal tax, and that amount is just under $3,700. At Oregon, the deduction here, there actually increases from $23,024 to $24,000 because of that PEAS limitation. So their home mortgage or charitable actually went up again. So because that PEAS limitation is gone, so their Oregon deductions go up, and which means their taxable income goes down, and they have an Oregon tax reduction of $97. Now, if we change the nature of this $400,000 of income and call it pass-through entity income, this last piece shows the impact of that. So with this income being pass-through entity income, under the prior law, it's the same situation. Everything's the same, and $87,000 of tax. But under the new law, so they lose their personal exemption, but their deductions go from $56,600 to $105,000. They lose some of their income tax deduction, but they get this 20% reduction for pass-through income. So in net, their deductions increase $48,000. And that means their taxable income falls from $340,000 to $295,000, a reduction of $45,000, and their taxes go down $27,682. And that's a 31% tax cut, almost a 32%. Now, assuming that we're tied to that provision, in Oregon, their itemized deductions go from $23,000 to $104,000. And so their Oregon deductions go up by $80,000. Taxable income falls by $80,000, and then they get an $8,000 tax cut here. Now, this piece, just for simplification purposes, ignores Oregon's pass-through entity policy, because there's still that question of how that would interact. So that would change the numbers a little bit, but the point of the way I've structured these numbers is just the impact of the pass-through entity deduction.
Make a comment?
Bueller.